You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks very much for having me.
The European Central Bank made some moves, quantitative easing again, that they say could last for quite some time. But it seems to me the market's reacting in a way where they're saying, so what? It's hardly anything.
Well, Jim, it's kind of a catch-22. On the one hand, yes, the efforts by the money masters, it does matter, and it is a form of manipulation. But ultimately, what matters most is not what they say or what they do. It's the structure of the market. And when I say the structure, I'm talking about the way the cycle's set up, the Dow theory non-confirmations, the internals, the Dow theory primary bearish trend change that occurred back in August that, believe it or not, is still in force. Those things are what's going to dictate the longer-term direction of the market. And the efforts that we're seeing by the money masters is an effort to save the market, obviously. I mean, that's not kooky talk. I mean, obviously, that's what they're trying to do. And in effect, they're trying to negate these technical setups that are in place. So they, too, obviously see that the market's in trouble, or they wouldn't be doing what they're doing. It's just common sense if you think about it. And so where we're at is, do these structural developments that have occurred. I mean, the market has been peaking realistically since March, when the Dow theory non-confirmation began forming. And so, realistically, does this stuff get blown out now with the counter-trend rally, or what I think is a counter-trend rally, or what is so far a counter-trend rally, I should say, coming out of the August low? Or do they blow it out, kick the can down the road a little more and save it? So that's kind of where we're at. We've been in this watching the paint dry mode to see how these structural issues develop for most of this year. And, what we're seeing now is it's an opportunity, if you will, for the advance out of the August low to roll over. It's at a very critical point. What happens? Well, I don't know. That's what we're monitoring. But if we get the right structural setup here, and then the die is going to be cast, and it's just not going to matter at that point.
Are they fooling themselves by trying to manipulate the market, just delaying the inevitable?
Not only are they delaying the inevitable, they are making matters far, far, far worse. And that's just a historical fact. Let me explain something. We haven't talked about this in a while. I know it sounds discrediting. I know it sounds crazy, but it is what it is. I mean, it's hardcore data. And, maybe I need to write another article and put it out there. And I may do that. After I'm working on the letter this week. I may get an article written before we do an interview again and talk about this. But let's go back and review a little bit to see where we're at. The secular bull market peaked in 2000. And, that's according to data. And when I say data, I mean, it's, the volume characteristics. We talked about the velocity of money. We talked about, job participation thing. But as far as the market is concerned, structure and volume tells us that. And there's some Dow theory stuff that tells us that, So as hard as it is to put your mind around it, just open your mind and think about something. We had the secular top in 2000, and we declined into the 2002 low. And another historical marker, if you will, of a secular bear market is the violation of the previous 4-year cycle low. Well, as we declined into the low in 2002, we went below the 98 4-year cycle low. So by every measure, statistical measure and structural measure, when we remove the emotion and we look at data, volume characteristics, again, the structure of the market, and even some of the underlying, economic factors like the velocity of money and so forth, everything tells us that yes, indeed, the market did top in 2000, the secular top. And so what happened as we roll over into that low, well, we want to keep that going. They want to keep it going. And so it's no secret. It's not conspiracy. It's fact that, we saw a liquidity campaign, and they did everything they could do to create the housing bubble, the banking crisis, and they pushed that 4-year cycle advance out of the 2002 low into the longest, at that time, what was the longest extension of a 4-year cycle advance since the inception of the averages in 1896. And the further they pushed that advance in 2005 and 2006 and into 2007, the DNA markers were not in place. I said that they weren't in place, and because of that we were seeing an extended 4-year cycle. And I also said over and over and over again that all they were doing was delaying the inevitable and making matters worse, and that when it set up, it wasn't going to be good. And I maintained then, I said that based on the fact that we were in a secular bear market that had been artificially pushed to a new high by the liquidity campaign, that the statistics also said that we would go below the previous 4-year cycle low, because remember, I just said that in a secular bear market, one of the statistical facts is that you go below the previous 4-year cycle low. Well, okay, 2002 went below the 98 4-year cycle low. 2002 was a 4-year cycle low. We get pushed up into the artificial high in 2007, and then we crack, and yes, we go below the 2002 low. So, like magic, that statistic was fulfilled. And just as I said, it wasn't brain surgery. It's just good common horse sense to look at something. I mean, the further you stretch it artificially, eventually the sanity comes back, and it, you pop back to the norm. But in that case, we overshot it just a little bit, and statistics were fulfilled, and we went below the low, but we had so far to fall that it was very, very painful. And so here we go. We come out of that low with even a greater liquidity campaign. They've pushed and stretched this market they've surpassed even the extension of the 4-year cycle into the 2007 top this time. And I want to add, though, that this time, the only asset class that we've really seen push to a new high, I know that housing's recovered some, but it's not like it was. But look at commodities. They didn't create a commodity bubble this time. Commodities are pretty much collapsing. The precious metals have rolled over. And so this time it's pretty much just equities. And so what they have done, it's again, if you just stand back and think about things, if equities are okay, then people think, well, the economy's okay, and so the pushing of equities to a new high has been camouflage. But in reality, this is even worse than 2007 because you've extended the cycle further. All this stuff still tells us we're in a secular bear market, even though we've been to a new high. I get that. But I'm talking about the underlying data tells us that. The new high is manufactured. I mean, it doesn't change the fact we're there. I'm not trying to argue that we're not there. Yes, we're there. I acknowledge that. What I'm saying is it's not natural. What I'm saying is it's extended. And what I'm saying is that we are indeed in a secular bear market. And I have to believe, based on all the history, that this is going to be just like 2007, that when it does finally set up and solidify and it gets going, that we are going to go below, I know it sounds crazy, the 09 low. And so if that's true, think about this. In a bear market, if you go below the previous 4-year cycle low every time, which historically since 1896 that's been the case, then by extending it this far, it has further to go. Wouldn't it have been better to have let it go from, I don't know, 12,000, 10,000? So that's what they have created here. And I think the money masters know this. It's a horrible position to be in, and I get it. I'm not talking if I was in their shoes, I'd probably try to, and maybe you would too. Maybe we all would. Maybe it's just human nature to try to, you don't want the bad times. You want to try to negate it. And, but I think that the reality of it is that, you have to have the ebb and flow, and Mother Nature has to have its way with the ebb and flow of the cycle. And, it can't be negated. Sure, it can obviously be manipulated and extorted, but it can't be, it can't be negated. And so, in effect, then, they have created a nightmare.
We'll have more with Tim Cyclesman Wood right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. See singing impressionist Andre Philippe Gagnon.
And I think to myself,
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, before the break, you said they have created a nightmare. What breaks first here? Or is it already broken?
Well, the breaking is, we have cracks. We have major cracks in the foundation. And like I said, we started trying to set up back in March. And we have. We've seen things. I mean, we had the Dow theory non-confirmation. It was followed by some cyclical stuff, which was followed by some internal stuff, which was followed by a Dow theory primary trend change. And really the only thing that I've seen that has been somewhat of a curveball is that, the August low, let me back up, because of the structure of the market in February, March, April, there was some question as to the phasing of the cycle. So that threw me off a little bit with the August low. I mean, I wasn't sure that the August low was going to be an intermediate term low, but it turned out to be. And I was thinking that we'd get this so-called second chance rally, if you will, from some point beyond August, like maybe out of a September, October, or even an early November low. Well, it came sooner rather than later, so that part was a little fuzzy. But with the August low, that clarified the cyclical count. And, like I said, we're still watching the setup. And, the crystal ball part, what people don't understand is, all I can do is interpret, go by the statistics, and the statistics tell me what they tell me. I mean, do we go below the, 2009 low? Well, obviously I don't know that with 100% certainty, but that is the risk, because of the track record of the statistics. So I have to stand by that until it proves that it's not. I mean, it'd be kind of crazy not to. And when you look at the immediate setup, well, it is what it is until it no longer is. And so what I'm saying is that, the risk associated with what has developed since March is still on the table. And it's going to remain on the table until it's morphed away and it's no longer there. Or it's going to continue to solidify to the point to where it does topple over, and then that's when the trap door to hell opens. And so we're still in that process. It's still trying to do whatever it is it's going to do. Can they kick the can down the road? I don't know. Flip a coin. But if it solidifies from here, it's not good. If it continues to push, then okay, it continues to push, and the setup, we're dealing with this for another who knows how long, until finally they just can't save it anymore.
Who's putting their money into the equity market with so many warnings about it being made?
I have no idea. I literally have no idea. I don't know why anybody would want to be long this that was a professional that understood what's going on. I think the problem is that a lot of the professionals really probably don't know what's going on. I think another problem is a lot of these fund managers and so forth have to be invested. If I was a mom and pop and in control of my money, I'd rather it be in a tin can and under the mattress or something than exposed to this risk. And I don't know, like I said, obviously, how and when and from what point it totally materializes. I just know it when we see it, as we see it, I can call it. But, the risk is tremendous. If we see a decline below, can you imagine? I mean, just go there in your mind. Think about it. Let's say that this does set up from this point, and we go below the 09 low, and let's say you do it in a year. Let's say you take that much of a decline. I haven't done the calculations, but I think it's close to, I don't know, I think it was like 65%, 60%, something like that. But can you imagine how devastating that would be? It's going to be global. It's going to be far-reaching. I mean, a 70% cut in the market is catastrophic. And so those are the risks. Regardless of I don't care if it happens or not. Based on the structure and the extension in 100 and however many years of market history, that is the reality. That is the risk.
I'm wondering about the price of gold remaining low. I just heard that Americans alone have increased their purchases of gold bullion by 207% in the past year, yet that hasn't been reflected in the price.
Well, back in 2011, in print, I called and warned as we moved into the top, for lots of reasons with the DNA markers associated with gold, that it was a 9-year cycle top, and I think you know that, and I said every rally from that point would be a failure that would be followed by lower prices, and I think you know that. And I can tell you now that we're at another, or near, we're near another short and intermediate term low. And gold is in a position where, like I said, I think we're going to have an intermediate degree rally. I'm not convinced yet that we've seen the 9-year low. I think we're probably a year away from the 9-year low, and then there is no telling, what could happen to the price of gold at that point once that low is in place. But I think we're at a point where we're starting to, with this intermediate degree low, we could start to build some sort of a base for that 9-year low over the course of the next 12 months. And then that's going to position gold nicely for the upside. But shorter term, we're fishing for the intermediate term low.
Tim, thanks a lot for chatting with us.
Jim, I appreciate it. The December letter will be out this weekend. I know some of this stuff sounds crazy, but people, it's facts. You can't argue with facts. And if it even remotely makes sense to you, or you have a curious mind, I highly recommend that you take a subscription to the letter. It's well worth the price. The education that you will get, I promise you, is pretty intriguing. It's eye-opening. I mean, to dig into the historical facts with the market and where we're at, it's a fascinating subject. And it's a teaching letter. I mean, it's not just something that says, okay, well, you need to buy this gold stock or you need to do this. No. It's a teaching tool using Dow theory and cycles, and it's pretty fascinating stuff. So consider a subscription if you want to know what's going on. Truly.
Thanks again, Tim.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.